Welcome back everyone. In this lecture, we will learn about features of options. There are 5 key features of an option contract. Type of option, underlying share or security, strike or exercise date, expiry date or the expiration date, and premium. Let's understand these features one by one. First is types of option. There are 2 different types of options: call options and put options. A call option gives the buyer the right but not the obligation to buy a given quantity of the underlying asset at a given price on or before a given future date. It means a call option entitles the buyer to either seek delivery of shares from the seller if he so desires or let the call option lapse. The seller receives a sum of money for selling their rights to the buyer. As a buyer of call option, you are hoping for the value of the underlying stock to rise. An increase in the price of the stock will result in an increase in the value of your option. And the seller of the call option receives a premium for taking on the obligation to sell the underlying stock to the buyer of the option if the buyer decides to exercise the option before the expiration date. For example, you have the right to purchase the house before the expiration date, that is the 3 months in this case. But you are not obligated to buy it, whereas the seller is obligated to sell the house even if the house price increase. If the buyer doesn't exercise the option, the seller simply retains the premium and the obligation expires with the option on the expiration date. Same concept applies to put option. A put option gives the buyer the right but not the obligation to sell a given quantity of the underlying asset at a given price on or before a given date. It means a put option buyer is entitled to give delivery of shares to the seller if he is making profit or let the option lapse. The seller receives a sum of money for selling his rights to the buyer of the put option. A person buys a call option when he expects that prices of share will rise, and he buys the put option when he expects that the prices of the share will fall. So if the underlying asset is in downtrend and prices are falling down, in that case you can buy put option. It means you are purchasing the right to sell the stock at a given price, and if stock price falls, you will make profit. Options will always have an underlying asset associated with it. It can be anything from an agricultural commodity, interest rate, foreign currency, or shares of a listed company. When the underlying asset is share, then it is called an equity option. Generally, an equity option is linked to 100 shares outside the India. It means when purchasing a call option, you are purchasing the right to buy 100 shares of that company. In India, the quantity of shares for one call option is different for different shares. Now, in this case, the underlying asset was house, and in this example, the underlying asset is a stock of company ABC. Strike price. The strike price is also referred as the exercise price. This is the agreed price at which the option can be exercised. For example, in this case, the strike price is 100k, that is the price at which house can be bought. There are a range of strike price set for each option, and we can trade any strike out of all these strikes. How to choose different strikes for adopting any option strategy, that we will learn later in this course. The current price of the share is known as spot price, and the current price of option is known as strike price. Strike price can be high or low of the spot price. For example, in case 1, the price of house decreased to 90k from 100k, so the spot price is 90k, and in case 2, the spot price changes to 120k, but the strike price is 100k, that is the agreed price at which the option can be exercised. Expiration date. Every option has a limited life that is determined by the option expiry date. Expiration date is the last day on which the option can be traded and is the date on which all exercised options expire. Equity options expires on the Thursday before the last Friday of each month. In this example, the expiration date is 3 months. It means the contract is valid only up to 3 months. Weekly options have gained in popularity, but they are still not quite as actively traded as the traditional monthly options. Option premium is the cost or the price of the option that a buyer pays to the seller to have the right to buy or sell the underlying shares. For example, in the last example, you are buying a call option of ABC share of strike 70. For this, you have to pay a sum of $200 for entering the trade. Now, if stock rises to $80, your profit will be $1,000 because stock rises to 80 from 70 and the lot size is 100. But your net profit in this case will be $800 because you have paid $200 at the time of execution of the trade in the form of premium. So by deducting $200 from this amount, your net profit will be $800. But if stock price falls to $60, you are not obligated to suffer a loss of $1,000. You will let the option lapse and your only loss will be the premium you have paid at the execution of the trade, that you paid to enter the trade as premium amount, and that is also the cost of your call option. Now in this case, the option premium is $3, but to calculate the total premium of a particular option, you need to multiply it by the number of shares covered in one contract. So in this case, the total premium of call option is $300. So these were the 5 option features, and with these 5 features, an option contract can be written as this ABC January 45 call at $3, in which ABC is underlying stock, January is expiration month, 45 is strike price, call is type of option, and 3 is options premium. So this was all about options features. In the next lecture, we will learn about leverage. Thanks for watching. See you in the next lecture.